A catastrophe worse than the 2008 Great Financial Crisis, and yet most people have never even heard of it, the repo rate spike. It's September 2019, and the financial world is blindsided. Overnight lending rates, usually calm and predictable, soar to a staggering 10% in a matter of hours. Banks scramble, funding seizes, and the Federal Reserve is forced to act immediately. This is the 2019 repo rate crisis, a hidden crack in the heart of the global financial system that could have brought the system to its knees. So, what a repo market is a very fancy way to describe an overnight loan market. It is massive. There's over $1 trillion per day. We can see yesterday, $1.12 trillion just yesterday alone was funded via this overnight a loan market. Every day, over $1 trillion is financed in this market. The way that it works is everyone participates, from a hedge fund to an investment bank to a commercial bank, a money market fund, pension funds. Everyone uses this repo market as a way to fund kind of operations. And so, say I'm a hedge fund, I need some money to enter a trade. I say, I want $10 million to enter a particular trade. Well, I'm going to have U.S. Treasuries, because everyone in our system has U.S. Treasuries. Those are the global collateral, the kind of backbone of the system. So I have, $10 million of Treasuries. I give them to a bank, right? That bank might have way more money than they need to do their operations for the next 24 hours. So they have this overabundance of cash. They're willing to loan me that cash, that $10 million, so I can enter my trade. And it's only on an overnight basis. So I will repay that $10 million back by the end of tomorrow. And like I mentioned, this is a secured loan. It is secured by government securities like a U.S. Treasury. And there's no default risk in that case. The bank that is loaning me the money, they have $10 million worth of government securities. So there's no default risk. There's an interest rate on that loan, right? So if I borrow $10 million overnight from the bank as a hedge fund, I might need to repay $10 million plus, I don't know, $10,000 on top of that. That extra money I'm repaying, that represents the interest. And of course, you take the interest rate and you calculate it on a 365-day basis, you get the amount that you would need to repay in addition to whatever principal you borrowed. Well, this operates on supply demand just as any other market would. There are two main components. There's the collateral, the U.S. Treasuries, the government securities, and then there is the actual cash. So the supply and demand of each of those is important. And what happened with the repo rate spike was there was an overabundance of government securities. Everyone had collateral. The problem is no one had the actual cash. Everyone had the collateral, no one had the cash. And so the shortage of cash led to the price of these overnight loans spiking in a matter of 2 days from about 2.3 all the way on an intraday basis. It was even worse than this. On an intraday basis, as high as 10%. So like 760 basis points in a matter of 2 days. Imagine interest rates spiking that much. Now, why did this happen? So we mentioned there is kind of an overabundance of collateral, U.S. Treasuries, and an undersupply or shortage of actual cash. So here's the kind of growth and inflation picture. It's very, very similar to where we are now in terms of nominal growth, real growth, and inflation. I do want to point out inflation here had bottomed in 2015 and had been kind of moving higher ever since. Here in 2018, it had gotten as high as 2.9%. Remember, this was Trump's first administration. Remember, the Fed's target is 2%. Inflation was not high, but it was also not low. And so the Fed was kind of worried about inflation. Well, here's the S&P 500. I will take it back to here's the election, November 2016. We can see, Trump was inaugurated around here. The S&P was in an uptrend, although there was significant volatility here. And not only was Trump president during this kind of crisis, and that's a big parallel, but trade and tariffs and all the similar sorts of things that were being talked about now were also being talked about back then. And that was having a drag on things like the S&P 500. There's also the taper tantrum, right? Fed monetary policy was causing some weakness in the S&P, and we will get into that in a second. In addition to finally the Tax Cuts and Jobs Act, the TCGA, which sure enough is what they're trying to extend right now with the one big beautiful bill. But here is the kind of overall picture for the S&P. It was, it was up significantly since the election, since the inauguration, but it had significant volatility. What I want to point out though is that when the repo rate actually spiked, the S&P was right up at like an all-time high. So, coming out of 2008, I mentioned monetary policy kind of driving this crisis. Here's, following 2008, and you can watch my QE video for more in depth on this. But following 2008, the Fed was engaged in quantitative easing, where they were printing bank reserves, increasing bank reserves, and buying treasuries and other securities. Those securities go on their Fed balance sheet, right? The value of this balance sheet gets more as the more that they buy securities, and the banks get bank reserves. Now you can think of bank reserves as half of the kind of monetary base. Currency in circulation is one half, and the bank reserves are the other half. So bank reserves are kind of the foundation in terms of U.S. dollars. The foundation, one of the two kind of main foundational components of the monetary base. And during QE, by definition, right, bank reserves are increasing because the Fed is creating them out of thin air, and they are given to the banks in exchange for the banks, giving the Fed securities, whether that's mortgage backs or U.S. Treasuries. And so we can see that coming out 2008, QE was, they took the balance sheet all the way from like 950 billion all the way up to like $4.5 trillion. This round of QE was kind of especially egregious and not really needed. Well, you can see the effect that had on the 2-year real yield. This is the 2-year yield minus inflation was negative. It was negative all the way from November of 09, all the way through really up until kind of May of 2018. There was this brief period of time where it went slightly positive, but in general, if you were buying 2-year treasuries, you were losing money. Inflation was higher than the interest rate you were getting. Well, why is that? The Fed was printing bank reserves out of thin air to buy bonds. That pushes the value of the bond up and the yield down below what it should have been. And here in white, we can see the Fed funds rate. It was basically zero all the way from December of 08, all the way through until October, November of 2015. They did a tiny little hike up to like 0.3, 0.4, and it remained there up until November of 2016. November 2016 comes around, Trump is elected, and the Fed takes the interest rate from 0.45 all the way up to a whopping 2.5. So about 200 basis points of hikes. Now, the reason, we had mentioned that tariffs and trade war and all that kind of stuff was being talked about. Well, the Tax Cuts and Jobs Act was also kind of being, I think that was passed in 2017, 2018, right? That was relatively stimulatory as well. Inflation was nearing 3% here in July of 2018, right? It was like 2.9%. And the Fed was worried about it. So that is part of what is explaining, the hike in interest rates. ZIRP, or zero interest rate policy, was never meant to be a permanent thing, nor was quantitative easing. And so just as quantitative easing increases the bank reserves, quantitative tightening decreases the bank reserves. So not only was the Fed engaged in hiking the overnight interest rate, but they were also engaged in quantitative tightening, where they were which was decreasing the amount of liquidity in the system in the form of bank reserves. And sure enough, here I marked in white when the repo rate crisis spike. When that happened, you can see the Fed balance sheet went up immediately. I think it was $75 billion a day. We will get to that, kind of how it all unfolded in a second. But this context is super important because just as QE increases liquidity, increases bank reserves, well, QT does the exact opposite. And that's what we had been engaged in all the way from 2017, 2018, all the way until the crisis, when sure enough, they had to reverse. But not only that, but they were raising the overnight Fed funds rate as well. They had actually cut ever so slightly when the crisis hit in September. They had cut, I think, like two 25 basis point cuts. They had cut very marginally, very similar actually to where we are now, where the Fed had raised rates. They'd cut them kind of ever so slightly relative to the range, cut them a little bit, engage in quantitative tightening. I'm not saying that there will be a crisis, but the number of parallels between now and then are pretty striking, in my opinion. So here we can see the effect of that. In red is reserve balances. So here we can see the effect of quantitative tightening reducing bank reserves. And remember, this is a drag on liquidity. This means there are less dollars in the bank's accounts at the Fed. So bank reserves went from about $2.78 trillion dollars to, at the low when the crisis hit, $1.4 trillion dollars. So there's about $300 billion dollars that was kind of sucked out of the system during this hiking cycle and quantitative tightening. Now, not only that, but there was another problem. September, October is when taxes are due, and everyone is rushing to get actual dollars to pay taxes. And you can see this reflected in the TGA. Every September, October, the TGA, which is the government's checking account, that'll spike, that'll move higher. And remember, when the TGA moves higher, that is liquidity being sucked out of the system. And so this is part of what led to the repo rate crisis. Was everyone was rushing to pay taxes. It was tax season. Everyone was rushing to pay taxes, and that has a negative impact on dollars. And we can sure enough see that reflected in the TGA. It spiked here from about $134 billion all the way to, in September, about $320 billion. So there was this kind of liquidity draw, not only from rising rates in terms of the Fed funds rate, but also in terms of quantitative tightening, where they are reducing the balance sheet and therefore reducing reserve balances. But then you also add on top of that, there was tax season, right? Taxes were coming due. So here is the yield curve. Again, remember, the darker the color, the longer the maturity. So the purple is the 30-year, the blue is the 10-year, green is the 5-year, red is the 2-year, this is the 1-year, and this is the 3-month. Now, this white line shows the effective federal funds rate, that overnight interest rate. And you can see that it spiked. But before it spiked, look at what happened to yields. So the 30-year went from 1.96 all the way up to 2.37. The 30-year had been moving higher in kind of early September. In those first 2 weeks of September, there were already arguably cracks starting to appear in terms of a shortage of dollars and an overabundance of collateral in the form of U.S. Treasuries. Remember, this would be reflected in higher interest rates. And sure enough, we see that with the 2-year, the 5-year, the shorter maturities, not as much, but we can definitely see it across most of the curve. There was already cracks starting to appear in early September. Here is what people call Fed net liquidity. This is the Fed balance sheet minus the reverse repo, which is a drag. It's a Federal Reserve operation. It is a drag on liquidity, minus that TGA that we had just looked at. And what this white line shows, as it goes up, net liquidity, or kind of dollars in the system, is going up. As this white line goes down, liquidity is decreasing. And so here we can see the effect. We had looked at bank reserves here in this one, and we can see bank reserves were coming down due to QT, due to rising rates. But here we see kind of the overall net effect, the overall net liquidity. And we can see that net liquidity here in 2015 was about 4.2 trillion. And at the heart of the start of the crisis in early September, it had fallen to 3.5 trillion. So there was a not insignificant draw down in terms of net liquidity. I do think it's also worth mentioning that the dollar, as measured by the DXY, at the time of the crisis in 2019, was right around the same level it is now. So not only is the president the same guy, not only is nominal growth, inflation, real growth, all that, not only is that very similar to where we are, not only is the TCGA being kind of tried to get passed, not only are trade and tariffs being talked about, not only is QT being engaged in, right? Like you start looking at the parallels, it is kind of striking. But the dollar was also right around the same levels, it should be pointed out. Now, sure enough, we know what happened. I'll get into the timeline in a second, but September 2019. Remember, this was just like a month or two before the first cases of that novel virus were starting to make themselves known overseas. Literally, just a month or two before all that. And what happened, as we talked about, with this kind of overabundance of collateral and this undersupply of actual dollars, of actual liquidity, is we got the repo rate spike. Well, the other piece of this was the deficit. So we mentioned an overabundance of treasuries, right, which are the collateral, and an undersupply of actual cash. Well, here in purple is the deficit as a share of GDP. We can see at the time of the crisis, we were running about a 5.5% budget deficit. Now, that is significant, and it should be noted that, that sort of level should not be seen outside of recessions. But remember what that represents. This deficit represent what that means is that treasuries, the collateral in terms of the repo market, are being pushed onto the market, right? With the bigger the deficit we run, the more treasuries have to get sold into the kind of market in order to fund the deficit, right? That's how we fund the deficit. And so we were running a relatively large deficit at the time. That also had an effect on, in terms of the supply and demand of the collateral, which is used for this in these overnight repo markets. And so here I will kind of zoom in. We can see that Friday, the overnight repo market rate was 2.3. By Monday, it was 2.6. And then by Tuesday, it closed the day at 7. Now, on an intraday basis, it actually went to 10, or right around 10% on an intraday basis. So kind of the way that it unfolded, we mentioned the context and how it came to pass. We mentioned the tax burden. We mentioned the oversupply of collateral due to the deficit, due to QT, rising rates, right, and tax season. We mentioned all of that. We mentioned that kind of the mid to long end of the curve had already, yields had already been moving higher, starting to indicate some stress, while the repo market kind of seized up, right? This is the funding market for the modern day financial system, and it basically totally seized up in the period of 1 or 2 days. Well, of course, the Fed stepped in. And so starting on September 17th, the Fed stepped in and injected, billions of dollars in liquidity in the overnight repo market. And that marked the first intervention going back to 2008, at least in terms of the repo market. Now we can see that QE had been being engaged in the entire time, basically, outside of the short period where they had tried to right size the balance sheet. But look at what happened to the balance sheet for the Federal Reserve. So we can see here in September, sure enough, they were able to only kind of QT out a very small amount that they had added. Remember, the Fed QE was supposed to be temporary, and it was supposed to be reversed at the end after we came out of the crisis, which sure enough is what Jerome Powell was trying to do, right? They talked about right sizing the balance sheet. That is what he was trying to do. Well, he was only able to get from 4.4 trillion down to 3.8 before, eventually, this repo market seized up, and they had to bail out, billions of dollars again into the system. And sure enough, the balance sheet would never see this level again. We all know what happened a couple months later. And we currently find ourselves at a balance sheet of $6.7 trillion, which makes the level heading into the repo spike look tame in comparison. But that's kind of the Fed's main goal, is to kind of be the buyer of last resort, to provide liquidity when it's needed, and intervening in this overnight repo market in particular was the first time since 2008. And I think it was, at about $75 billion per day. That was the peak of this kind of Fed action. So it was not $75 billion per day every single day. That was the peak. But it would range between 10, 20, $30 billion a day was being injected by the Federal Reserve, printed, and then injected into the repo market in order to bring that rate down. Because just as we established an overabundance of collateral, US Treasuries, an under or shortage of cash, just as that would cause the rate to go up, what would cause it to go down? Well, a huge supply of cash, right? If you increase the one of the two sides in that equation, right? If you have a shortage of cash and you have the Fed step in and print tens of billions of dollars a day to inject in terms of cash, well, you equalize this equation and you bring the rate down. Just as a shortage of cash caused the rate to go up, an overabundance of cash could cause the rate to come down. And sure enough, you can see what happened. The rate actually went down. Heading into the crisis, we had mentioned it was 2.3. Well, we can see that following the intervention, it would not return to 2.3 for a long time. So this goes, I will try to take this out as long as possible. We can see that we did not reach back to that 2.3 level until the hiking cycle of 2022. Sure enough, we know the events, right? A month or two later, a bunch of cases were announced of this brand new virus no one had heard of. Sure enough, the Fed had to print trillions of dollars to deal with that as the kind of global economy came to a screeching halt. This overnight repo rate would not return to that level for a long time, for many years. It did not return to 2.3 until August of 2022. And you can see that this actually went almost negative. The repo rate, this was, like I had mentioned, the opposite can also be true, which is if there is a shortage of collateral and an overabundance of cash, this rate will come down, right? And sure enough, this is what we saw during the stimulus, right? Was a huge amount of money printing and stimulus. Well, if there's an overabundance of cash and a shortage of collateral, this rate can come down and theoretically it could even go negative, which I'm sure it probably, almost came close to a couple of these days during 2021. But I think hopefully that was a good, short, brief explanation of the repo market. Most people have probably never heard of this. This is the way that the kind of modern day system is funded. If the Fed had not stepped in and printed tens of billions of dollars a day to bring this rate down, everything would have stopped. You do not take borrowing costs from 2.3 all the way to 10%. You do not increase borrowing costs that quickly, by that much, that quickly, without bringing everything to a screeching halt. Everything from this would have been worse than 2008, arguably, and maybe as bad as COVID. So, anyways, hopefully that was helpful and a good intro into the repo market. Sure enough, there is also called the reverse repurchase market, and maybe that could be the next video. If people are interested, leave a comment. That is what we would end up seeing. But anyways, yeah, hopefully that was helpful, and I will catch you in the next one.